Hello, thanks for joining our Tax Insights live webinar. Whether you're joining live today or whether you're listening to our recorded version, thanks for joining us. So today we're talking about why a demerger might be the best solution for your client. So over the next 30 minutes or so, we will talk about why we might use a demerger, different types of demergers and the mechanisms, the tax reliefs available, and then we'll also have a look at a brief case study example. So firstly, what is a demerger? It's essentially a separation of a business into distinct entities. It might be separation of assets, it might be separation of different types of operations, or it might be separations of ownership if owners have decided to go their separate ways, each taking part of the business with them. It can be for strategic, commercial, or tax reasons. For example, we've had a few recently where a company is going to be sold, but the buyer does not want to take on a building or a warehouse that the company owns. So we need to try to get that out of the company before it's sold. So that's a typical kind of commercial example of why we might do this kind of thing. It might be to manage shareholder expectations. It might be for succession planning, a whole variety of reasons that this might be done. As we've said, dispute, sale preparation, risk insulation is another one. So why consider a demerger as opposed to just selling, in my example, the warehouse or the building out of the company? The issue, if you just separate a company into two parts, you transfer some assets out, then you're going to have a taxable event. The company will incur corporation tax if it transfers any assets out. The shareholders might have tax to pay, and we're going to go through shortly what taxes we need to be considering. And the alternative is a demerger that's structured properly, which is what we're talking about today. And that means that there can be no capital gains tax or income tax if it's all structured properly. Everything happens in the right order, and HMRC give clearance. It can be tailored to business strategy. So although certain types of demerger, there are steps that have to happen in certain orders, the idea of a demerger is that it's always bespoke. You can't fit the client's circumstances into legislation. We have to look at the legislation and say, what does it require? And therefore, how can we commercially make this work for our client? There's no point setting up something that works beautifully from a tax perspective if actually it doesn't work commercially for the client. So it does need to be flexible within the bounds of legislation and obtaining the tax advantages that we are looking for. It can align with future sale plans. It can separate growth and risk profiles, and obviously everyone has a different attitude to risk, so that will look different for every business. And there might be a family and business harmony to consider in some scenarios. So you can see it's always going to be bespoke to the type of scenario. So the first thing we always do when we're looking at any kind of demerger is have a call with the client to learn more about their objectives. Even when, as is commonly the case with Allegro Tax, the work is brought to us by our very kind accountants and lawyer referrers, we will always have to have a call with the client themselves just to understand their objectives, anything specific we really need to know that's very relevant to the circumstances, because we want to tailor the plan to suit them, and it's not just a one-size-fits-all thing that we roll out for everybody. So when we're looking at a demerger, there are 4 tax problems essentially we want to solve in order to obtain a tax-free demerger. Firstly, income tax distribution for the shareholders. We don't want them to be taxed as having received a dividend of either of the asset they've received. Capital gains tax. We don't want them to be treated as having received a capital distribution and therefore having to pay CGT either. They're looking at the original company. We don't want it to be taxed as having made a capital gains disposal and having to pay corporation tax on any chargeable gains. And then if there have been any assets transferred intra-group between subsidiaries in the last 6 years, we don't want to crystallise any degrouping charges. So when we're planning a demerger, they're the 4 tax problems that we really need to solve, because if we can't solve all of those problems, we don't have a tax-free demerger. We haven't. We've wasted tax. We've had tax leakage we didn't need to have. So in the UK, there are essentially 4, and and they're all suitable for different reasons. And so the first exercise we always do when we're asked to look at a demerger is a piece of work to determine which demerger is appropriate. So we would need to look at the distributable reserves. If there are not distributable reserves of at least the book value of the business being demerged, then certain types of demerger won't be possible. Does the group include trading and non-trading activities? Because if there is a mix, again, that will preclude certain types of demerger from being used. Is there an intention to sell part of the demerged business? And this is really key, because some types of demerger are not suitable if a part of the business is going to be sold. And it is very common that this is the reason for doing a demerger, is that a buyer has shown an interest in one part of the business. So we have to be really careful with that one. Other factors are, is the subsidiary being transferred, resident in the EU? Is there likely to be a chargeable payment within 5 years? And the chargeable payments regime is quite complex, very wide ranging, but essentially if there are going to be payments out to shareholders after the demerger, that will have an impact on which demerger we can use. Is a degrouping charge protection needed? So as I mentioned a few moments ago, if assets have previously been transferred around a group on a tax-free basis, and then a subsidiary holding an asset is sold, we will need to think about whether that crystallises degrouping charges and whether we need to try to protect against those. And is there a need to avoid a liquidation for commercial reasons of one of the companies? Because as we'll talk about, liquidation demerger is one of the options. So we've got there's a whole table that we would work through of actually if for example, the intention to sell, that means a statutory demerger is not going to be suitable. We know that straight away. So we need to work through the circumstances of each client scenario to determine which demerger structure is going to be suitable. So that's always stage one, that analysis. And then following that, advanced clearance should always be sought from HMRC. So once we've done the piece of work to decide which type of demerger is suitable, we've run through that with the client, they're happy that it meets their commercial objectives, they understand what's going to be done, then the next stage would be obtaining advanced clearance from HMRC that they're happy that the criteria for obtaining the release from all the taxes that we talked about a few moments ago are met. So in terms of the mechanism of how it actually works, usually the first step is to reorganise the holding company share capital so that the first shareholders' shares become, say, A shares, and the second shareholders' shares become B shares. And that is so that when you start to pay out dividends on each class of share or dividends in specie of assets, you can actually get the assets to the right individuals. You can stream the assets to the right class of shareholders. And as long as the shareholders are getting equal value, that sort of reorganisation, changing ordinary shares to A ordinary and B ordinary shares, shouldn't have any tax consequences. It's usually pretty straightforward. So that's usually the first step, is that reorganisation of holdco. So that has to be put in a steps plan as the first step. So then once that's been done, we look at our 4 types of demergers. As I say, we would do a piece of work to work out which of these is going to be the best one for the client scenario. So number 1 is a statutory demerger, a direct demerger. This is the most simple one. The target company pays a dividend in specie to its shareholders of the subsidiary to be demerged. So you go from a parent subsidiary structure to shareholders owning each of the companies individually. Second type of demerger, another statutory demerger, and this time it's an indirect demerger. And in this one, the target company pays a dividend consisting of either a subsidiary or some business assets, not to the shareholders as individuals, but to another company or companies, and those companies issue shares to the shareholders. So you end up with a sort of triangle structure there. Those 2 statutory demergers are not suitable if any part of the business is going to be sold on after the demerger. So as I said earlier, it's very common. That is why a demerger is being used. So although they are probably the sort of most straightforward to understand, to explain to clients, often actually just not going to be suitable because the criteria are not met. But certainly the first ones that we would consider. Next, a liquidation demerger. As I mentioned earlier, this does involve actually putting the company that's to be demerged into liquidation, and then those assets of that company will be distributed to new companies that have been set up by the shareholders. Obviously, often for commercial reasons, people don't want the company to have to be liquidated because they think it doesn't look great. Perhaps people would see it on Companies House and wouldn't understand why it's happening, and worry about the commercial impact of that. So not necessarily as popular as number 4, capital reduction demerger. I say until recently, I think it was Companies Act 2006 that made it easier to actually do a capital reduction demerger. So for that reason, the liquidation demergers are far, far less popular than they used to be. So with a capital reduction demerger, through a reduction in the company's share capital, the demerger takes place by a reduction in the company's share capital, and then when the share capital is reduced, the assets are paid out to shareholders. So rather than liquidating the company, we can just reduce its capital, and then the assets are paid out to shareholders that way. When we do the analysis, that's very often the one that we end up recommending, often because, as I say, there's going to be a sale, so the first 2 statutory demergers aren't possible, and the liquidation demerger, people don't want a liquidation unless they absolutely have to. So a capital reduction demerger often is often the answer, not always, but is very often the answer. Should just mention here, I mean, this isn't a formal sort of type of demerger, but there is always the option just to do an asset sale demerger. So essentially, if a company's got an asset it doesn't need anymore, just to sell it. It's simple, it's quicker. You wouldn't get HMRC clearance or anything like this, but it's most likely to trigger some sort of tax charges there. But it can be useful if the group or the asset in question is quite small. The shareholders might decide with advice that actually it's not worth the professional fees and the legal fees, the tax fees and the legal fees to actually do a formal demerger, and actually they may as well just do an asset sale and demerge that way. And also, if it's urgent and there's no time either to plan it out or to go to HMRC for clearance, a decision might be made commercially just to do an informal sale and do the demerger that way. So in terms of tax reliefs, I mean, there is a very specific set of legislation for each demerger under which statute, which paragraph, which act the reliefs take place, which I don't propose to go through here because I don't think it's particularly necessary. But essentially, where the criteria are met for each demerger of the types we've talked about, there should be no income tax for the shareholders, no capital gains tax for the shareholders, and no corporation tax for any of the companies. So there are very specific tax reliefs in place that apply to each type of demerger to mean that those taxes are not incurred if everything is done correctly. So that's what we're always looking at when we structure the demergers. Are we meeting the criteria for each very specific tax relief? So in terms of pitfalls, what might go wrong? So the tests, the criteria might not be met for the reconstruction rules to apply, and that might mean the tax reliefs are not available. But again, we plan this very carefully and we get clearance from HMRC to minimise that type of risk. Anti-avoidance rules have to be considered, not just the very specific legislation for each demerger, but the wide anti-avoidance rules, just to ensure that nothing's falling foul of those. A post-demerger sale voiding relief, as I said a couple of times, if there's a sale on the cards, that does preclude certain types of demergers from being the most appropriate choice. And if a statutory demerger is chosen, and then there is a sale later, the relief might be void, and essentially all the structuring will not be relevant. Poor coordination with legal steps. We always have to ensure that we work really closely with the lawyers on the demerger. We have lawyers that we work with that we can put people in touch with, or we can also always work with companies' existing corporate lawyers. But it's really important that we all, as a professional team, work really closely. Usually it starts with the tax. Structuring that will come first. Then that tax steps paper will be provided to the lawyers. They would then follow that in order to get the documentation in place. But of course, we are always available to look at paperwork, to answer questions, just to make sure that nothing in the way that it is drafted means that the tax result that we had intended isn't available. So it's really important that everybody stays connected and coordinates when the implementation stage of the demerger is taking place. So in terms of a very simple case study, just to illustrate the practical applications of this, we had two brothers with property and businesses. Brother A kept a property company, brother B ran the trading company, and they wanted to separate them so we can use a capital reduction demerger to actually separate those two companies, and then both brothers can go their separate ways. And the reason that would be a capital reduction demerger is that one of the criteria for the simpler statutory demergers that we talked about is that there can't be any non-trading activity in the group. So here, because there's a property company involved, property business involved, we can't use a statutory demerger, so we would have to use a capital reduction demerger or a liquidation demerger, and most people's preference would be capital reduction. If we need degrouping charge protection, however, as we said earlier, because you've had assets moved around a group, you've almost got the opposite effect. A capital reduction demerger is not going to achieve the protection against degrouping charges. So in that case, you're more likely to go for a statutory demerger. So it does work both ways. You do really have to consider, the circumstances, as I said a few times. So in terms of overall outcomes, looking at it holistically, we should have no capital gains tax, income tax, stamp duty, or corporation tax, in fact. Operations would therefore be independent. You've separated the parts of the trading business, or you've separated the trading and the investment business, or whatever the scenario is. And the structure after the transaction is aligned with business and commercial goals, which is our ultimate aim. At Allegro Tax, those of you who know us will know we're very commercial. We always start from the client's commercial objectives. We are not ones to kind of come with a ready-made solution and try and get your client to fit in with it. We do it the other way around, and we start from what they need to achieve, and then we build the tax around it. And therefore, we aim that for our clients to end up with a really aligned tax and business strategy. So in terms of final thoughts, tax follows strategy. As I've said, commercial rationale, absolutely key. Pre-clearance is essential because these are complex transactions, particularly the capital reduction demergers are complex. So we do send our steps plan to HMRC plenty of time in advance with all the information about the commercial rationale, so they can sign off on it and say, yes, we're happy that this meets the criteria for the desired tax reliefs to apply. Important to model all outcomes, so you need to look at the different types of demerger. What would that look at? What would that look like afterwards? If there is a choice of two demergers, they might both work on day one, but you might then have a scenario where clients are restricted from doing something they want further down the line, like selling part of the business, for example. So you would choose the other option in order not to restrict them in that way. And then finally, always work with legal and tax advisors from the absolute earliest point onwards. This is complicated stuff. So the earlier you can get the lawyers and the tax advisors around the table talking about it, making a plan, the simpler and more effective and more straightforward it will be. So it seems to have gone very quickly today. So if you do have any questions, please put them in the chat. While you do that, yes, thank you for listening. I do appreciate you coming along with us live, or if you are listening to the recording, obviously, please do get in touch through LinkedIn or through our website with any questions. Our next session is on Wednesday, the 20th of August, and that is helping your clients with employee share schemes. So we will be looking at EMI schemes, company share option plans. We'll be talking about SIPs and Save As You Earn schemes, although only briefly because they're not usually relevant to our clients. But we'll also be talking about bespoke schemes and what we can do if none of the statutory schemes or the tax advantage schemes, as they're named by HMRC, are suitable. So what we do in that case, and I'm going to do some examples of clients we've worked with who didn't fit into those schemes but needed something more bespoke. So please do put that one in your diary. I'll get the link sent around ASAP. Right, just going to have a quick look at the chat. Okay, so somebody said, I have a client with property and trade in the same company. What would be the best way to separate these? Okay, so as I said a couple of times, I mean, she's very bespoke. I'm never going to sit here and just say, right, kind of that's the answer. I mean, what I would say is that if you have got non-trading activities, so property investment, we wouldn't be able to use the two statutory demergers. So we wouldn't even sort of spend time going through all those mechanisms because there wouldn't be any point. So we'd be looking at a capital reduction demerger or a liquidation demerger. So we would look at both of those. We would model all the outcomes. And then obviously we'd look at the size of the business, because sometimes if the scale of the business isn't large, then an informal demerger or just a sale is worthwhile. So we would keep one eye on that option as well. But I would say most likely in your scenario, a capital reduction demerger or a liquidation demerger is probably going to be the answer. But in order to get to give you one final answer, as it were, we would need to look through the circumstances. You've come up as anonymous, so I can't contact you. But if you would like to drop me either a LinkedIn message or get in touch via our website, very happy to have a free introductory call just to have a chat through the circumstances and see how we might be able to help. So I don't think we have any other questions, so I will leave it there for today. Thank you very much for joining. I do appreciate your time, and please do put your next session in your diary, and I will look forward to seeing you then. Thank you.